I believe we're going into the parabolic part of the S curve. And so in that parabolic part of the curve, we could potentially see Bitcoin be way more asymmetric to the upside and have more of a muted to the downside, right, because we're in the parabolic growth part. Trump gets Powell out sooner and drops rates to 1.5% in the next 30 days. So there's a lot of things that could happen. But I would just say, based off of what we can see in the on-chain data, it's probably going to be somewhere, I'm sort of thinking in the 150 to 250 range, maybe 200 is sort of the median of that. If Bitcoin can capture 1.25% of the store of value assets by 2030, that'd put it at $21 trillion, or $1 million per Bitcoin.
Mark Moss begins by framing the current macro environment. This year's tariff shock disrupted trade flows and rattled markets, but beneath the surface, liquidity is ramping back up. And liquidity, he reminds us, is the single biggest driver of asset prices. Consider this: the United States has already attracted over $8 trillion in committed investments. Add to that the political dynamic, Donald Trump pushing hard to pressure Jerome Powell and the Federal Reserve.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
We had this tariff shock that happened this year, and that disrupted things, right? And now it's getting going again. But now the seeds of that we're seeing planted. So like number one, we have $8 trillion of commits to start investing into the US. That's a lot of money.
Yeah.
Number two, we have Trump. You mentioned, rates, but Trump has been very aggressively trying to get Powell to either budge and lower rates or out or neutered, potentially electing a shadow chair that could usurp what he does. But he's out either way, in the next 6 months.
Yeah.
We know that just a couple days ago, at the time of this recording, Ursula von der Leyen from the EU came to the White House and just got schooled like a little girl by Trump. And basically the EU caved to every single tariff demand that Trump had, including investing, I believe it was $900 billion into the United States and for military. Where does that money come from? Oh, they print it, right? We can look at China right now is injecting more liquidity in their system. Over the last 6 months, it's almost like a parabolic turn up. And so we can see all of these things happening. So it does look like global liquidity will start accelerating through the end of this quarter and could easily go into 2026. Understanding what Trump is trying to do, if he can get rate in 6 months, get rates from whatever 5, down to 1.5, which is where I think he wants them to go, that's going to ignite a whole nother boom.
Yeah.
And so there's a lot of reasons why I think we could see global liquidity continue to at least hold, if not start to accelerate. And then in regards to Bitcoin specifically, we've seen a major makeup shift in the owners of the holders of Bitcoin. And so right now we're seeing Bitcoin treasury companies, public companies, and even governments are buying 10 times more Bitcoin than is what is being produced through Bitcoin mining. So the demand is way outstripping the supply. Where is this supply coming from? Well, a lot of retail is selling. So it's going from individual retail hands, and it makes me sad, but it's going from weak retail individual hands and going to the corporate, institutional, and sovereign hands. And the thing is, with Michael Saylor, is he's we're never selling. We're just not selling. And a lot of the corporations are doing that, and the sovereigns will do the same. And so I think what's also interesting is seeing that go from retail hands to now institutional cold storage. That could also change that 4-year cycle trajectory as well. I believe we're going into the parabolic part of the S curve. And so in that parabolic part of the curve, we could potentially see Bitcoin be way more asymmetric to the upside and have more of a muted to the downside, right, because we're in the parabolic growth part. So we already talked about the change in the makeup of buyers from retail moving into the cold storage of either sovereigns or these treasury type companies, number one, so that we've changed that. So we have more buying and less selling. So more parabolic to the upside, which happens to overlay with the S curve. I think another thing that I think about is when you look how things are traditionally done with companies, you think of the law of large numbers and the diminishing returns. And so Bitcoin, has had an amazing growth trajectory over the last 15 years. But over time, it's gotten slower. So like over the last 5 years, it's gone up by about 85% compounded annual growth rate, the CAGR. The last 3 years, it's about 65%. And a lot of people expect that to continue to dwindle down. I think Saylor says he thinks it averages around 21% over the next 20 or 30 years, something like that. And so we just sort of expect it to continue to trend down. I do think there's a possibility that we might see CAGR actually start to accelerate a bit for a while. And the reason why I would say that is because traditionally what we see with financial assets is VC money funds it, institutional money comes in pre-IPO, it gets listed, and then it gets to the public who writes the small checks. So you get the big checks first, the big explosion, and then it's continued with little checks of retail, so it grows much slower. But Bitcoin is the exact opposite of that. Bitcoin started small, with small checks funding it. Now we're getting to the big check size. And so it's completely upside down. And so maybe it grew slower with the small checks, and even though it's a bigger number today, we're getting bigger checks, and we could potentially see CAGR start to move back up again, or at least maybe hold, pretty solid. So I think between the change in the makeup of the buyers, the parabolic part of the S curve, the way that the big checks versus the small checks have come into the ecosystem, there's a real possibility of that. If we look at, MVRV, or we look at, the pi cycle top, we look at some of these types of indicators, it gives us like a range of where we think, because they're moving averages, we're not sure where it's going to converge. It looks like it's in the 150 to 250 range, so it's looking like the median of that is, maybe a 190 to 200 range based off of that data. There's a whole bunch of stuff. I mean, if Trump gets Powell out sooner and drops rates to 1.5% in the next 30 days, so there's a lot of things that could happen. But I would just say, based off of what we can see in the on-chain data, it's probably going to be somewhere, I'm sort of thinking in the 150 to 250 range. Maybe 200 is sort of the median of that, the store value assets, to 1.6 quadrillion by the end of the decade, by 2030, 3.6 quadrillion by 2040, and I think it's 8.5 or 8.6 by 2050, because they project out to 2054. Now again, I think that's conservative, because they're going to print and spend more. Okay, so that's how big the basket is growing. Now, Bitcoin is a store value asset that's in there. So the next question we have to ask ourselves, and this is an assumption, is what percentage of that basket do we think it can get? So when I'm investing as a venture capital fund into Uber, well, taxis are this big, limos are this big, van shares is this big. So collectively it's this big. If I can get 5% of that market, I'll be worth this, right? So we know that Uber and Airbnb both captured 10% of their market in less than 10 years. It doesn't mean hotels are gone. There's still hotels, but we have Airbnb. Doesn't mean taxis are gone, right? And so what's happening is Bitcoin is growing faster to take a little bit of the market share from real estate and from bonds and from equities. So the question we ask ourselves is, what percentage of that basket do we think we can get? Well, if Bitcoin can capture 1.25% of the store of value assets by 2030, that'd put it at $21 trillion, or $1 million per Bitcoin. Now, we can check that math in a couple ways. Number one, we can look at the compounded annual growth rate, the CAGR, and how it's been sloping down. So I told you it's 85, now 65. That would finish the decade at a 50% CAGR. And we're already above that, so it'd have to drop pretty low to end up at about, so that's at a 50% CAGR. We'd end up at $1 million, 1.25% of the basket. So $1 million by 2030 is my target. We've seen Arthur Hayes say I think he said $1 million by 2027. Kathy Woods says 1.5 by 2030. We'll see. Okay, now let's go out to 2040. If Bitcoin could get to, again, following CAGR, continuing to diminish down, let's say it drops down to 30% for the next decade. Following the growth basket, if it can get to 8% of the store value assets, it puts it at $14 million per Bitcoin. And by 2050, if we continue the downward sloping of the CAGR, maybe it gets down to 20% at that point. And I just gave you reasons why it could even accelerate, but let's just continue, it goes down. And by now, I believe the Bitcoin can get to 20% of the basket. That puts it at $45 million per Bitcoin.
Looking further out, Moss continues the exercise. By 2040, if Bitcoin captures about 8% of the store of value basket, it could be worth $14 million per coin. By 2050, if it reaches 20% of the basket, that number rises to $45 million. Even with a declining CAGR, say dropping to 30% in the 2030s and 20% in the 2040s, the combination of expanding liquidity and Bitcoin's unique position as a scarce digital store of value makes those numbers plausible.
I don't really think in where it will be in 6 months from now. Right. I'm happy to play this game, and we'll throw out a couple numbers. I think anybody trying to look at their portfolio on a monthly or quarterly basis will never make it.
100%.
Charlie Munger said that the big money's not made in the buying and the selling, the big money's made in the waiting. So I need to wait, number one, for the opportunity to develop, and number two, for it to grow. That's where the big money's made. Warren Buffett, his partner, said that if new investors came into the world knowing they only had 20 moves their entire career, 10 buys and 10 sells, they would outperform everybody. So I think if you're looking at your portfolio on a monthly basis, you're going to drive yourself crazy and you're never going to succeed. So let's start with the bigger picture, and then we'll answer the shorter term picture. So I have a whole video breaking this down. I'll send it to you. You can link to it down below. And I have all the math. And so I will give you the high level math, but if they want the detailed math, they can get into this. So when global liquidity goes up, asset prices go up. Okay. So as the government continues to expand the debt-based monetary system, money goes up, asset prices go up. The government, the US government's Congressional Budget Office, the CBO, projects out the next 30 years to 2054. So they tell us what they expect the deficit spending to be, the debt levels to be, the annual spending budget to be. They give us that. Now, in my opinion, they're going to be way off because they always spend more and increase the debt faster than they expect, but they give us the next 30 years. So I'm using this as an example. The first thing, if we go backwards in time a little bit, just so people can get an understanding, we have what's called store of value assets. And so we make money and we buy things, but eventually creators create more than they consume and they save it. And they're typically going to save it in store of value assets, which would be equities or bonds, maybe cash, gold, collectibles, art, things like that. Okay, that basket in 2010 was about $364 trillion. Today, that basket is about $1,000 trillion, or 1 quadrillion. So from 364 to 1,000. So it's about tripled.
Yeah.
Okay, in 14 years.
Moss stresses that the biggest mistake investors make is obsessing over short-term moves. Watching portfolios daily or monthly leads to emotional decisions and poor performance. Quoting Charlie Munger, he reminds us, the big money is not made in the buying and selling. The big money is made in the waiting. He adds Warren Buffett's thought experiment. If you only had 20 trades in your lifetime, 10 buys and 10 sells, you'd likely outperform everyone else. The lesson is clear. Zoom out.